This is Smart Investing with Mike Wren.
Securities and advisory service offered through KMS Financial Services.
This is Smart Investing with Michael J. Wren. With Michael's producer, Chris Martin. You can email us your questions. Go to smartinvestingshow.com to see how.
For I have the pride, the privilege, nay, the pleasure of introducing to you the one, the only.
This is Smart Investing with Mike Wren.
Well, hello there again, everybody. You have tuned into, you've pressed play on another podcast of the Smart Investing Show, where we try to take the topic of investing. Number one, we try to make it easier to understand. Number two, we try to get you good, relevant information on each and every show. And thirdly, giddy up, we try to be entertaining. And with the entertaining portion, that's usually Chris. The producer extraordinaire, the person who puts up with me, Chris, on the other side of the table, as always. Welcome to this Saturday morning. Thanks for coming a day later.
How many people do you introduce as, here's someone who puts up with me?
It's pretty much everybody.
Everyone in your life, right?
Yeah, in my family, and then you recanted. I saw your mouth. You were going to say family, and that's like, no, everyone in your life. Yeah. Clients would probably be even included with that. These listeners,
family has to.
All these 8 podcast listeners that we have, they would be putting up with me.
It's getting better.
9,
at least. I think at least 11.
Sweet.
I brought 3 of my own. So I brought 3 people who put up with me.
That's awesome. So we're filming. We're recording this show on a Saturday. Just it's a little bit different for us. Over all the years we're used to Saturdays more than weekdays.
Yep.
And the title of today's show, when Chris puts it on the website and in YouTube and all that, the title is going to be Winter in July. That's a hell of a title, wouldn't you think?
Winter is coming.
Is that clickbait? Wouldn't that be, clickbait or something?
No, clickbait would be more like 5 things Mike Wren tells you that you'll die from. Click here.
Okay, I guess it's not that.
Are your investments going to die in the next week?
Yeah. I think clickbait, my compliance people wouldn't like that. How to double your money in 30 minutes?
Yeah. I told you my plan, right? I'm going to have an online fishing store called Clickbait.
Really? Perfect?
Just seems perfect. I don't know why it hasn't been done.
And on mornings like today, I got to tell you, my mom had I think my mom's 120th high school reunion was going on.
Uh-huh. Yeah, that's
like, because she graduated 120 years ago.
Like 3 people there?
More than you would think. And I was helping and barbecuing.
It would have to be more than I would think.
I was barbecuing for this crowd of people, salmon fillets and hamburger sliders. Like I told you, I'm wore out this morning. It's like I feel like complaining, and I need a drink with an umbrella in it already, and it's not even 10 o'clock in the morning.
I can't believe there wasn't more soft food being served. Just saying. When I had one of my high school reunions, it was at this place where there were 3 restaurants in it. It was like a mall type thing.
Okay.
And
that is called a mall, by the way.
Oh, okay.
It's a mall type
thing.
It was like prison. No, it was called prison. It actually is prison.
It was weird because it was kind of the same restaurant, but there were 3 different sections of it.
Okay.
And ours was the 20th, and then I saw the 40th and the 50th were there also celebrating the same time. And as you walked down, you just saw less and less people. Like,
more
in
Jell-O
each one.
and more Jell-O.
No, I just saw less and less people, and that worried me a lot. So which one am I going to make it to?
I've never gone to one.
Never gone to one, huh?
Never.
I had to just after the whole selfie dad thing because I was famous.
Yeah.
I just wanted to see what girlfriends I dodged a bullet from.
All of them?
All of them.
All of
just
them.
the ones that could make it.
All of them. Nice.
Some mail doesn't get to mobile home parks, so.
Oh, gosh. We could go on such a tangent with us being so close to Otis Orchards and so close to North Idaho. But we'll digress. Like I said, on this show, we'll get to some investing stuff here. The reason I'm calling it Winter in July, because I wanted to. Because when you, the podcast listener, anybody out there, when you're You're bombarded. You don't even get a choice. You're bombarded with crap because sometimes you want to hear something from the media industry via your car, the radio in your car, via satellite link or just local broadcast, or the TV, or maybe the internet, or you read it in print. So you're going to access the media at some point in time, and the media is going to tell you that, oh my God, when it comes to investing, by the way, oh my God, a recession's coming. A market downturn has to be right around the corner. Holy crap, the world's going to end. And
the media is like a small child. Once it's got your attention, it doesn't want it to let go.
Yeah, it's like a small child combined with a pit bull, I think, combined with Vladimir Putin.
That has a hold of part of your junk.
Yeah,
just not letting go.
Yeah, and it's part Vladimir Putin from Russia and part some inflammatory comedian. Pick one.
Let's go with Cosby.
Yeah.
Louis C.K.
Yeah. So anyway, recession. What is a recession? Okay. The definition of a recession, my definition, is when our economy is shrinking instead of expanding. Notice that I didn't say World War III, nuclear weapons, trade war, war of the worlds, celebrity warfare, whatever you want to call it.
Battle of the network stars.
Yeah, it's just the economy is shrinking and not expanding. And, mark my words, go any of the McDonald's that are in the area. Even as successful as a McDonald's store is, I could see that a McDonald's would in 1 year maybe have less total sales than the prior year, or maybe no growth. I could easily see less sales. Let's say that they had road construction by a store, and then that they did some sort of a renovation, even though that those happened fairly quickly. Let's say that the cost of inventory went up a bit, maybe the price of the coffee, the price of the pop, the price of the input costs, and maybe let's say you're in Seattle and everybody in Seattle says, oh, well, we want to make, even though we never graduated high school, we deserve $30 an hour. I mean, I'm being part of the media right there.
And free weed.
Yeah, and free pot. And I'm being inflammatory, obviously. But let's just say a combination of those things happened, and your fast food restaurant, for total sales for a year or for some significant period of time, didn't equal the prior significant period of time. Is that the end of the world? No. Is it pleasant? No. Does it cause you to raise your eyebrow and maybe check, like when you check your check register when there's less money in your account than you think? And it's like, where the hell did I spend that money? And so you go through and you figure out, oh, that's right. I forgot to write down in my register that check that I gave to Chris that was such a large amount. So anyway, don't laugh so hard.
Lots of things went through my head.
So yeah, you've done that, and that's what a company does. That's what's going to happen when the economy shrinks the next time. You're going to see your statement. More than likely, you're going to see it go down. And you're going to think, well, crap, why is it going down? What the hell? And you'll start checking it. And guess what? More than likely, you might not be able to figure out why, because it's not your simple check register. There's a little bit more going on. And so when you can reassure yourself that, I made that mistake and, that's what happened, or you found an accounting error, that's not going to happen when you do that with your investment account. You're going to look there and more than likely, you're not going to be able to reassure yourself. But a recession is nothing more, nothing less. So this is my opinion this is a psychological handbook from me, Mike Wren, to help you get through the next time our economy shrinks and you see your statement go down more than you'd like for a longer period of time than you'd like, okay? In my eyes, a recession or the market going down is just like a moderate to major snowstorm. Probably more like a major snowstorm. And that's what I mean by talking about wintertime in July. You're going to be listening to this podcast, and more than likely it's going to be hotter than Hades outside. It seems like it gets a little bit hotter more quickly, and you're going to be trying to do your yard work earlier in the day. You're going to be adjusting your behavior because you don't want to sweat so much. And I think that's typical. You'll see people that take walks, they take them earlier in the morning. If there's things that you want to do, it's like, oh gosh, even if you're going to a ball game, it's like, okay, I want to make sure I put on some sunscreen and, take a little, if I haven't spent that much money on drinks before, I'm for sure going to spend it today.
You second guess normal things that you do.
A little bit. Yeah. You just think about it more. Yeah.
Yeah.
So it's just, and so us talking about a snowstorm right now is kind of odd. It's easier to talk about the snowstorm when we're in July because you don't have to get out your shovel. You don't have to get out the de-icer. You don't have to wonder if the tires on your car are going to be fine. You don't have to worry about you don't have to worry about any of it because it's July, okay? Well, that's why I want to talk about this now because, a recession's going to happen, and we only really know when a recession is going on after it started, when the government 9 months later said, oh yeah, we dipped our toe in the water, and yeah, it's actually a recession now. We kind of figure it out after the fact. So number one, how is a recession akin to a major snowstorm? Number one, predictions of it far outnumber how often it occurs. So when you're watching the news, obviously the news people are going to say, we're looking for a doozy, and we don't get a doozy.
It's Snowmageddon.
Yeah. And you're thinking, oh, well, okay, we avoided that. Same thing with the investment industry. You get all of the finance people out there saying, now be prepared, now look out, and nothing's happening. Same exact thing. Because why? Because they can't tell the future. Number two, severity is almost always less than predicted. Even when we get the snowstorm, almost always it's less inches than they say. It's kind of like the fishing story. I caught a fish this big, and I caught a fish this big, and I caught a fish this big. And you'll notice that when they get a little bit more inflammatory, they'll say 2 to 4 inches. Oh, it might be 2 to 8. They'll put a shotgun range on it because they want to be right.
Men have a harder time figuring out inches. That's, 4 inches does equal 8. I don't know if you knew that.
I've heard that, but again, I'll try to lasso this back to the investment.
That's the rule in my house. I'm just saying.
So that's what's going on, is that the severity, they're always predicting that the severity is going to be off the scale, and it almost never is. Number 3, the majority of people, when the snowstorm actually happens, the majority, they grumble or complain. Okay? They complain about the snow. They're grumbling about the snow. And guess what? When we get a major snowstorm, there's a few of us that get a smile on our face and we wax our skis. You get what I'm saying? Is that it happens. The vast majority of everybody is complaining and thinking of it as a negative thing. And I'm waxing my skis, getting ready not to go into work because people are going to think, oh, the roads were probably bad. He just probably decided, no, I left even earlier than I normally would to go have fun. Yeah, I'd much rather get up 2 hours earlier to go skiing than get up the normal time just to go to work. That's just the way it is. So what everybody else sees as a pain in the ass, I see as a wonderful opportunity to play hooky and get in some turns into some fresh snow. That's just the way it is. You see how it's a different way of thinking. And that's the same thing when you have a recession. It's not all bad. There's going to be some good deals out there, but the vast majority of people are too busy grumbling and complaining. And number 4, we kind of alluded to this. The media makes the emotional swings a lot more wide, a lot greater. The media, if you're going to, it affects me kind of in a weird way. I'll get amped up. It's like, oh man, a major snowstorm. I'll get ready. I'm going to think that I'm going to play hooky, and I can't because there was no snow in the first place. So conversely, everybody else is, oh, isn't that great? We didn't get the snowstorm. And me, yeah, it's fine. Yeah, great. Yeah, I'm glad. Yeah, good for you. Yeah,
good for you.
Yeah, good for you, dear. We didn't get the snow. Where I'm kind of irritated. Number 5, the world, your world, hasn't changed. Winter doesn't last forever, and neither do recessions or down markets. Okay? So that's my handy Swiss Army knife. And truly, it's nothing more than that. When the economy shrinks for a time, it always does. It's always temporary. We can never really predict it ahead of time with any regularity. So the predictions outnumber how often it occurs. The severity is almost always less than predicted. The majority of people out there complain when you can actually take advantage of the situation. 4, the media makes stuff worse. And 5, the world hasn't changed. So no matter if it's a bad snowstorm or no snowstorm at all, or if it's a severe recession or just a mild one, the world hasn't changed. The bad news isn't going to last forever, and neither is the good news. And in a way, what the media is playing on here is a psychological instance that kind of happens in all of us depending on the day. There are certain times when when I feel like complaining about the world because I wish it was a different way. I wish that winter was longer. I wish that summer was shorter. I wish that, kids behaved all of the time. I wish I was able to, work 3 days a week and make the same amount of money. And people will look at me and think, what the hell are you on? What dream state are you in? It's the same thing. When you get a statement that's got negative numbers on it, you might be tempted to go into a dream state and kind of complain to yourself. It's like, I wish things were different than this. And you're going to maybe be in a bad mood for a short period of time. It's just that one part of your brain saying that I wish my reality was different than what it really is. And there's a few ways to combat that, but just understanding that it's probably more a psychological event than an economic event is a big step in the right direction, because this economic stuff is always going to happen. It was happening before you were born. It's going to be happening after you're dead. So it doesn't realize that you are upset or happy at any one time. It just is what it is because it's the reality. So when you're going through kind of these emotional situations, realize that it's emotional. Instead of trying to justify the emotion with fact, maybe embrace the emotional part. Even when you call me, and if you see your statement being down and you've done the math and the percent and it's down more than you want, kind of take stock and see how that makes you feel. And, maybe you might be saying, I'm down this much of a percentage. I want you to explain it to me. Or I looked at my statement. It's not making me feel good. Tell me how you can reassure me. There's a couple different things, and if you're willing to do that,
and then you'll say, well, why don't we walk over to Mamby-Pamby Land?
No. Okay. Depends on the day. Yeah. If I didn't get the snowstorm I wanted, yeah, you might.
It's a Friday at 4:00.
Yeah, I'd say, so you're calling me Friday at 4:15 to complain. Okay, I can do that. So anyway, as far as I think we might have actually 3 segments to today's show. So this was the first segment. Winter in July. Recessions are nothing more than a name for the economy contracting instead of expanding, and the recessions are always temporary. We never know how long that they're going to occur, and don't worry about it. It's actually an opportunity if you think about it the right way. So we'll take a quick break, and we'll come right back.
Ladies and gentlemen, I hope you can hear the sound of my voice.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.
This is Smart Investing with Michael J. Wren.
How about you're welcome? How about I'm so happy to be here for you all so I can take the blame?
Okay, we are back. So enough about wintertime in July. How about we'll talk a little bit about mutual funds, timing the market. We'll just talk about general stuff. So I am looking at the July 9th edition of Barron's Magazine. And on page L16 and L17, there's an interview with a couple people that actually have really good reputations as far as investments go. An interview with Jim Lowell and Dan Weiner, Advisor Investments. Now, Chris is laughing. In this room, you can hear all the sound. He can't even hide it. If we were in the radio studio, he would probably dip beneath the counter.
This would be the part where my wife goes, "Grow up."
Yeah, grow up, Chris. So anyway, I think Chris's laughter is enough. It's an interview with these guys. It says, this article starts out, when it comes to where Americans put their money, few firms have the same name recognition, loyalty, and track records that Fidelity Investments and Vanguard Group do. Both came to prominence in the 1970s and have dominated American savings since then. Vanguard has more than $5 trillion in assets under management. Fidelity directly manages $2.5 trillion and has nearly $7 trillion under administration in its brokerage, retirement plans, and other accounts. Okay, in the 1990s, another duo arose to assess the two firms, each publishing a guide to these two huge, frequently confusing fund complexes. Specifically, Dan Weiner, editor of the Independent Advisor for Vanguard Investors, and Jim Lowell, editor of Fidelity Investor and Fidelity Select Investor. Okay, one is 62 and the other is 58, and they followed the active managers of the two firms, and they basically tell you what they like and they don't like. There's just a few quotes in this article that are really, really, I think they're relevant for sure. One quote, it's on page 17. It's at the top here. It says, it's from Dan. He says, healthcare is quickly becoming 20% of U.S. GDP. That would be gross domestic product. How could you not want to have a significant weight there? And what that means is, how could you not want to have a significant amount of your investment money there? The baby boomers aren't going to retire to their porches. I have friends who are replacing their hips and knees all the time. They are still skiing and riding bikes, and they will replace those knees and hips again, which is true. That's different. I mean, I hate to bring up that my mom's, high school graduation, what do you call
reunion?
That? Yeah, high school reunion. But that was the main thing. People were talking mostly about their health care, mostly about their pains and all that. My mom's talking about how she rehabbed one knee that she had replaced, and how, by God, she'd rather build a garage than pay $20,000 in deductible for another knee, at least right now. People are looking at her like she's crazy. Well, that's my mom.
Because my thought was, there's a metal detector at the reunion, and it took forever for everybody to get in.
Yeah, I had to wand every single
person.
So, yeah, that's the way the world is. And, the pharmaceutical and healthcare industry, it's a growth industry, and it's also steady. It provides a lot of opportunity, because it seems like the consumer base that it serves is always growing. It seems like the consumer base that it's serving is dying less frequently. And it seems like that the things that the consumers buy are increasing all the time. New pills, new drugs, new knees, new hips, new eyes, new everything.
As long as there are shows like Jackass and Tosh.0, there's always going to be a need for the medical community to come up with different replacements.
Yeah, and that's even the young ones. That's young
right.
people. That's not we're definitely not talking the baby boomers. And here's another one, this Dan Weiner, another couple quotes. It's from this article. It's, the Barron says, how do you know when you've succeeded? Dan, he says, when they repeat back things to you that you've said. Buy the manager, not the fund. Lowell, eat your own cooking. Back to Dan. Time in the market, not market timing. And this is one thing that I wanted to bring up. Take the issue of target date funds. And I'll interject here. You see these target date funds a ton in 401k plans. In fact, many times when people are coming to me looking to roll over their 401k, many times, if their money isn't in some large index fund, it's for darn sure in a target date fund. The fund companies are saying, Well, we can't educate everybody, so we'll just use their birth date as the metric. You have to educate people. The notion that you can pick your allocation, which means the investments that you own, based solely on the year of your expected retirement date is ridiculous. This is him saying it, not me. I hate target date funds. I always have. I think they're total BS. Here he goes again. You can have two people with the exact same age, same job, and the same employer, but one is married and stands to inherit $3 million, and the other is a single father and has no inheritance. Yet they are supposed to invest the exact same way? And then Lowell comes in. For the majority of people, they are better than passbook savings account, but we aim to do significantly better than that. So just that one comment alone, I can't tell you how many times that I see somebody invest in target date funds. I can't tell you how many times that I see the fund companies telling people how wonderful these target date funds are. And it's like he said, it's ludicrous. It's asinine. You can't get more stupid. It's just them trying to sell you crap or saying that you already are buying from us. Let's make it easier. You don't even have to put in the very limited thought that you put in before. You can put in almost no thought. Just give us your birthday. We'll tell you that it's all good. It's kind of like these Social Security seminars that my competitors in my industry get. They use the topic of Social Security benefit to try to get people to come into the door. It's a little bit like offering you a free steak if you bring a friend or whatever. They're trying to get you in the door. And I guarantee you at one of these things, they're going to touch you. In other words, they're going to be at the door. They're going to try to...
You don't even need to give me a steak. I'm coming. I will bring a friend.
They're going to shake your hand. They're going to give you a business card. They're going to want you to sign up for like a free set of snow tires. Why? Because they want your contact information so they can bug the shit out of you. Okay? And that's not me. But anyway, that's their gig. And they're going to tell you at this retirement seminar, oh, God, you should wait to take your, let's just say they don't even tell you. Anything that they tell you at one of these Social Security seminars as to when you're going to take your benefits is probably wrong. How can I say that? How can I make such a general statement? Well, it's pretty easy. I'm pretty sure they don't know when you're going to die. Unless you tell them when you're going to off yourself. Unless in
my birth certificate has an expiration date.
Yeah, if you don't know when you're going to die, then all of the information that they're giving you based on your death is wrong. They're just going to say, "Oh, if you don't take your benefits at 62, if you wait to 66 or 7, look how much more you're going to get per month." Yeah? Look how much you got between the time that you waited. That would be zero. So that's what we need. And they like to say that, oh, we're the self-appointed saviors of you people. We'll for damn sure help you. You can't. You don't know when you're going to die. That's the real world.
So they're basically like a really bad girlfriend. You're happy to meet them at first, then they're really clingy and they want to be there until you die. You can't get rid of them.
You're right. And that would be my definition of 90% of all financial radio shows now. They use some sort of inflammatory thing to try to get you to listen. And from listening to Chris and I, we don't care if you listen. But if you do...
We're not doing anything on a Saturday at 8 in the morning.
But if you do listen, we're going to do our damnedest to get you good information that's relevant no matter who you talk to or work with. Not if you just talk to us or work with us. What we're giving you on this podcast is relevant no matter where you go, because it's some of the immutable truths in the world, like the one that you can't tell the future. I mean, we all know that, but these people that say, oh, if you do this and this and this, it should work out great. Well, that's a big should, They have to be right in order to help you out. And Chris and I, we try to be able to help you out without having to be right or wrong. Sometimes there is a such thing as good advice without having the huge burden of being right about it. Sometimes it's easier than that.
I've been married for 28 years, so I've never been right in 28 years.
For 20, yeah. So anyway.
I remember being right at the 29th, but...
So anyway, that was it on that article from Barron's. Let's take another break, and with the last part of the show, I'll talk about what I charge clients and why I charge it. We'll be right back.
You're listening to Michael Wren.
Maybe we should chug on over to Mamby-Pamby land, where maybe we can find some self-confidence for you, you jackwagon.
Imagine, if you will, a C-list internet celebrity and his wife. Do I sound okay?
You sound bald.
28 years of marriage with 3 kids.
Shayla, Garrett, Austin.
No one knows these people. How many were in the room? Orlando,
Shut up!
Jafefe, Jesus, Miranda.
And
Trying to do a podcast from their home. Had a joke coming.
Just
I won't say it.
keep it to yourself.
Keep it to myself. Kids in the room. Kids
Keep
in
it
the
to
room.
yourself.
Kids in the room. Kids in the room.
Is it for entertainment? Or is it something more sinister?
I was spanked with a saddle because he couldn't find anything. I was spanked with a wooden spoon. I was spanked with a metal spoon. This time in Bangkok, I was spanked by an
Okay, yeah.
5-foot girl dressed as a tooth fairy.
This is a dimension of podcast like no other.
So if you've got questions, we got answers. You got
I don't know if
kids?
they're the right answers, but we got
Absolutely
answers.
not. I'm telling you
Any
to
other
torture your
parents?
kids, not spank them. I don't know what kind of answers I'm giving you.
It is an area which we call the Burr Martin Podcast.
I forgot I don't smoke it. Somebody take these cigarettes away from me, please. So join me and my wife and co-host Janny, plus the occasional kid interruption for the Burr Martin Experience Podcast, uploaded weekly on the Pants Pending Network.
This is Smart Investing with Michael J. Wren.
My wife and I are big fans.
I just don't get it.
That's because you were raised by granola chopping tree people.
Okay, back from that break. Thanks for letting Chris and I talk about things for a minute. So, last part of the show. Let's talk about what my industry, what my competitors, what I charge for my services. Basically, the biggest service that I try to provide clients is to make them more money than they would make on their own. It's as simple as that. Of course, my competitors will say, well, you know, I charge because we have telephone calls. Well, really? You're gonna put that down there? I charge because we have meetings. I charge because I look at clients' portfolios. Well,
We charge because Sarah has to have the better coffee in the office.
well, yeah, I mean, though they make all of this, they make all of these excuses, and my excuse is, I'm trying to make you money. There's a lot that goes into it, and all the accounting and all the customer service stuff, I don't really bring up because I think it's kind of a given. It's like, no, duh, of course.
Well, phone calls are part of your job.
Yeah, but not my competitors. You ought to see the Denny's menu that they'll give people. They basically give them a sheet of paper that tries to justify their value on earth, and I try to make my value on earth whatever their statement says.
So you're more of an automobile receipt where it's, we replaced this and it cost us this, and they're more of a Comcast. Well, it's this original price, but then you have all these tiny little fees.
They might. Me, it's just that I try to make people money, and that's how I gauge my own performance, is if I think and can prove that I'm doing better for them than they do on their own, and also against my competitors, I guess. So nowadays, it's starting to transition where it used to be 20 years ago that most of the time that you'd just be paying somebody commissions to buy or sell stuff. And when you were dealing with somebody from the insurance industry, they would say, oh, there's no commissions at all. Well, that's because they're kind of hidden. You'd be buying an annuity that would have quote unquote no commissions to it, but you'd have to leave your money there for a certain amount of time, or you got penalized to take your money back out, kind of like golden handcuffs or poisonous handcuffs. You had to leave your money there. You know what I'm talking about. You couldn't walk away at any time without taking a significant portion of your money away. Well, now the industry's trying to go and is changing towards a flat sort of a fee based on assets. So, where you're being charged a percentage of how much money that you have whoever managing for you. And even the insurance industry is slowly trying to go that way because it's kind of the way the industry's going. There were a few Department of Labor rules that wanted to do away with commissions, and they're always up in the air, but that it just is that way. So I'm always transitioning my book since I've been in the industry almost 30 years. My practice, I'm forever having conversations with clients that have been with me forever that say, look you've paid me commissions to buy or sell things for you for the last 15, 20 years. I'd like to change you to a fee-based schedule because I'm not being compensated enough for what I do for you. I don't buy and sell to make sure that I get paid enough. So sometimes there will be a year or more that goes by where there isn't any transactions being made, and if I'm being charged, if I'm being compensated by commission, I will not have made anything over a year or more if there hasn't been a transaction. Which, as far as the transactions go, that makes sense. Sometimes you don't need to do a transaction in a year or more because the investments that we have are doing what we want them to do, pretty much, in general. What isn't good about that is, and what isn't reasonable, is that me being the paid professional, not being paid. It's as simple as that. So my industry typically will charge its clients 1 to 1.5% per year, and sometimes it's a lot more than that. My competitors will say, I'm going to charge you 1.25% per year, but then as a point of fact, they'll actually be kind of charging more, or the client will be charging more, because if they're saying that I'm going to charge you 1.25% per year, what if they're using mutual funds? Well, those mutual funds have their own expense ratio. Let's say it was Vanguard or Fidelity. They have their own expense ratio. So that Vanguard and Fidelity, as an example, is managing the money first person. So they're going to have an expense ratio, paying their managers, paying for the statements being printed, and so on. Then your person, kind of a middleman, is charging you an extra 1.25% to do whatever it is with their Denny's menu that they said that they're doing. And all of a sudden, let's just say Vanguard, it's a nice actively managed fund. Let's say the expense ratio is 0.5%. So now you're knocking on the door of 2% per year. I will never charge more than 1% per year, and I can't even think of any account in my practice right now that I do charge a full percent. They are all less than 1%. Why would I do that? There's a couple reasons. Number one is that I like to be reasonable. I like to be able to look in the mirror, and I like to think that I am easily far and beyond worth what I'm being charged. That way I sleep well at night, and that way if it ever becomes into some sort of whether I'm worth it or not argument, if somebody thinks I'm not worth it, they can totally go pound sand and go deal with some other form of reality that they're seeking because I'm a good deal,
Every night my head hits the pillow, I think, tomorrow they're going to find out I'm a fraud. Every night.
Number two, I don't want to charge so much that when I have clients taking their income in retirement, that I could be the difference taking one extra vacation per year. If I'm charging 1% or 1.5% per year and they are taking 5% per year out of their account, that means that they're taking 6.5 total out of their account instead of maybe 5.5. And that might make the difference. It might be $1,500, $2,000, which might be the difference of them taking an extra vacation, which is why they hired me in the first place, is to make money so they can live a little bit either more secure or have a little bit more fun. And the final reason that I typically charge less than my competitors is my competitors are extraordinarily simple-minded. They look at how much money that they have under management, and they think to themselves, if I charge a certain amount, then I'm going to make this much a year, and that's a pretty good income for myself, and blah, 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 blah. That's truly how they think. That's frankly how my industry tells them to think, so they make sure that they're profitable and stay in business. And right now you're probably throwing up in your own mouth because you haven't heard them talk about how much they're making you. The reason I charge what I charge is because I'm hoping for and factoring in a level of growth. If I'm good at what I do, I'm hoping like crazy that I can get you some sort of a level of return that's growing your wealth over time, that's better than what you could do yourself and better than my competitors. So I figure it's much, much better to have a pool of assets that I'm managing the best way that I can and trying to hope and plan for some level of growth. Because that means if that growth does happen, you, the client, will make more money, and me, the advisor, will make more money. It's a win-win situation. That's pretty much it. It's been the show Smart Investing. Thanks again for listening, and we'll be back again, same place, same time.
Remember, if you have any questions or comments, you can always write smartinvestingshow@gmail.com. And also, if it's easier, we are now on YouTube, so you can listen while you scan the internet. Just go to smartinvestingshow.com, and there's a link at the top of the page.
Thanks for listening.